Welcome to the Deep Dive. We're your shortcut to getting truly well-informed, distilling the key info you need.
That's right.
Today, we are diving deep into Hilton's second quarter 2025 earnings call.
Yep. Gonna unpack the numbers, the strategy, what management's thinking.
Exactly. We'll break down the financials, the big strategic moves, and the outlook. So you walk away really understanding Hilton's performance and where they might be headed.
And there's definitely some interesting stuff this quarter. It's not all straightforward.
Okay, let's jump right in then. Because Hilton, well, they delivered really strong bottom line performance in Q2, beat expectations on profit, even though the top line was a little soft.
Yeah, that really stood out. It shows the leverage in their model.
So how did they pull that off, especially with that top line softness you mentioned?
Well, it comes down to how they operate. Looking at the key numbers for Q2, Adjusted EBITDA, it actually broke $1 billion. Came in at $1.08 billion.
Wow, over $1 billion.
Yeah, up 10% year over year. And that was a big beat compared to what they guided for. Now, okay, some of that beat was timing, things like non-RevPAR items hitting the books maybe a bit earlier.
Right, like loyalty fees or credit card revenue.
Exactly. Stuff outside the daily room rate. But, you know, the adjusted diluted EPS, earnings per share, that also came in strong at $2.20, also beat expectations. So the profitability was definitely there.
Okay, profitability is a clear win. But then there's RevPAR, revenue per available room. System-wide, it was actually down 0.5% year over year.
On a comparable currency-neutral basis.
Driven mostly by occupancy slipping a bit, even with rates up slightly. So how do those two things fit together? Strong profit, but slightly down RevPAR. What's that telling us?
Yeah, that's the key thing to unpack, isn't it? While RevPAR itself dipped, their core moneymaker, the management and franchise fees, that actually grew 8% year over year.
Ah, okay, so the fees kept growing.
Right. It suggests that even if room revenue per hotel softened a touch, the overall system activity, the volume they're managing or franchising, is still growing nicely, and they're collecting those fees.
Makes sense. And they're still returning cash to shareholders.
Oh, yeah. Big time. Returned $1.7 billion so far this year through buybacks and dividends. They're still on track for about $3.3 billion for the full year.
Okay.
And they just authorized another dividend for Q3, 15 cents a share. So yeah, despite that little RevPAR wobble, the cash engine is strong.
So on the surface, maybe a bit of a mixed bag with that RevPAR number, but underneath, strong profits, strong shareholder returns. Now let's dig deeper into that RevPAR because management had a point about that dip, didn't they?
They did. They were quick to point out that, yeah, reported down 0.5%, but if you adjust for holidays, calendar shifts, timing quirks.
Right.
System-wide RevPAR might actually have been slightly positive. Modestly positive.
Okay, that's a really important clarification. So the underlying demand maybe wasn't quite as soft as that headline number suggested?
Exactly. It changes the picture. If you break it down by segment, leisure transient RevPAR, actually up 1%.
Okay.
Helped by a longer spring break this year, easier comparisons to last year, so leisure held up.
But business transient?
That was down 2%. And that was hit by those holiday timings, but also weaker government spending, fewer international inbound travelers, and just sort of general economic uncertainty kind of weighing on things.
But they did see some pickup later.
Yeah, they mentioned an early pickup in non-government business demand starting in Q3. So maybe some green shoots there for corporate travel.
And group RevPAR, the big meetings and events.
Roughly flat overall. Company meetings were doing okay, trending favorably. But convention business, social events, a bit softer.
Okay, flat now, but what about looking forward?
That's the positive part.
Yeah.
They highlighted momentum in corporate-led volumes. And group bookings for 2026 and 2027 are already showing high single-digit growth.
So the future pipeline for groups looks really solid. That's key.
Absolutely. Yeah. Then you look regionally, and it's a varied story again. The U.S., their biggest market, down 1.5%.
Following that business, transient, and group pressure we just talked about.
Exactly. They expect U.S. RevPAR growth for the full year to be kind of at the lower end of their overall system range.
But outside the U.S.?
Better. America's outside the U.S. up a strong 3.8%. Luxury lifestyle resorts doing really well there, expecting mid-single-digit growth for the year.
Europe
grew 2%. Continental Europe group business was strong. But they see low single-digit growth for the full year because the UK and Ireland are still a bit weak.
And the Middle East and Africa, that number jumped out.
Oh yeah, surged 10.3%. Record travel around Eid, Hajj, Easter, big events driving big numbers, expecting mid-single digits for the full year there too.
Asia Pacific seems like a mixed story there too.
Overall, up just 0.3%, but you got to split it. APAC, excluding China, was up 5.2%. Japan and Korea saw strong group business.
But China itself.
China declined 3.4%. Weaker corporate travel in Tier 2 and 3 cities, some government policy changes impacting travel. So China's softness pulled the overall APAC number down.
And the outlook for APAC for the year.
Roughly flat, assuming China sees modest declines continue.
Yeah.
So, yeah, really different dynamics depending on where you look.
Okay, so we've picked apart RevPAR, different pressures, pockets of strength. Now let's shift gears to what fuels Hilton long-term. Growth and development, net unit growth, NUG, was really strong in Q2, right?
Yeah, really impressive. 7.5% NUG in the quarter. That translates to a 52% increase in actual hotel openings year over year if you exclude acquisitions and partnerships. Just organic openings.
52% increase in openings, that's huge. And they're confident about the full year.
Very. Still guiding for 6% to 7% NUG for the full year. They said solidly in that range.
What's driving that confidence? The pipeline.
Absolutely. Their development pipeline is massive, over 510,000 rooms now, growing year over year, growing quarter over quarter.
And a lot of that is actually being built.
Nearly half is already under construction. And construction starts are up 16-17% this year. So it's not just potential deals, shovels are hitting the ground.
And a big part of this story seems to be conversions, taking existing hotels and rebranding them as Hilton properties.
Huge part. Conversions were over 33% of their openings in Q2. And they expect that to be 40% for the full year.
40%. So they're basically mastering the hotel makeover. Why is that so important right now?
Well, think about it. Interest rates are higher. New construction can be tougher, more expensive. Conversions let them grow market share, add rooms to their system without necessarily needing brand new buildings everywhere. It's smart, capital-efficient growth.
Makes sense. Which brands are leading the charge on conversions?
Several are doing really well. DoubleTree just hit 700 hotels globally, entered its 60th country. LXR, their luxury collection brand, debuted in Paris by converting this amazing 18th century building.
Yeah.
Tapestry opened its first spots in Northern Ireland, Turkey, Hawaii. Curio popped up in Vienna and launched their first all-inclusive Curio resort in the Dominican Republic.
So it shows they can plug existing, maybe independent hotels into their system and boost them.
Exactly. And then there's Spark, their newest conversion brand. That thing is on fire.
Tell me about Spark. The numbers sounded wild.
They are. Opened over 40 hotels just in Q2. It now has over 170 hotels open across 6 countries. And there are roughly 200 more in the pipeline.
Wow.
And get this, they said it's the highest market share brand within Hilton's entire portfolio.
Highest market share. How is that even possible for such a new brand?
It suggests they found a real sweet spot in the market, likely converting properties that maybe weren't performing well under previous flags or as independents, and Hilton's system just supercharges them. It's expanding internationally to Saudi Arabia, Puerto Rico.
Almost sounds like a cheat code for growth. And they're not stopping there with conversions.
Nope. They expect at least 2 more conversion brands by the end of the year. One will be a collection brand in the lifestyle space, targeting unique, maybe boutique-y assets.
Plus, they launched a new extended stay brand.
Yeah, LivSmart Studios debuted in July, aimed at the long-stay market, based on a lot of research. And they mentioned work on several other new lifestyle brands and even alternative accommodation concepts. A couple of those might launch by year-end, too. They're constantly innovating.
It's not just conversions and new brands, though. Strategic expansion globally seems key. Waldorf Astoria opening in Helsinki, Bali, New Delhi.
Right. Nomad Hotels launched in Singapore and Detroit. Canopy signing deals in Tokyo and Italy. Tempo in Canada. Tapestry in Saudi Arabia. It's a real global push.
And even their focused service brands like Hampton and True.
Expanding globally, too. Hampton going into Thailand, Tron to Vietnam, Spark, as we said, Saudi Arabia, Puerto Rico. It's hitting all segments, all geographies.
And they specifically mentioned big growth plans for India and Africa.
Yeah, really ambitious goals there. Talking about expanding tenfold in India, tripling the portfolio in Africa over the coming years, targeting those high-growth emerging economies.
So beyond the physical hotels, the pipeline, what really anchors Hilton's strength, you have to talk about the brand and the loyalty program, right? Hilton Honors.
Absolutely critical. Hilton Honors just keeps growing. Over 226 million members now.
226 million.
Up 16% year over year. And here's a fascinating stat. Membership is now split pretty much evenly, 50-50, between the U.S. and international travelers.
What does that 50-50 split tell you?
It shows how truly global their reach is now. It's not just a U.S. program with some international members. It means they're attracting and keeping loyal customers worldwide. That drives direct bookings, which are more profitable. It's a huge competitive moat.
And the brands themselves keep winning awards. Hilton named Most Valuable Hotel Brand again.
Nth year in a row by Brand Finance. That's not just vanity. Brand value translates to pricing power, guest preference.
And it's not just the fancy brands. Hampton, Home2 Suites. Truth, their workhorse brands also got top marks from J.D. Power.
Exactly. It shows quality and customer satisfaction across the board, not just at the high end. That consistency is vital. Plus, they keep getting recognized as a great place to work globally. That helps with execution, keeping good people. It's a whole ecosystem.
Okay, let's pull back and look at the bigger picture, the investor context. Management sounded quite bullish on the U.S. economy, didn't they? Which is what, 75% of their business?
Yeah, really optimistic about the next few years in the U.S. They pointed to several things. A regulatory environment they see as more favorable, more certainty on taxes, global trade policy may be settling down.
Okay.
Plus continued healthy corporate profits, and importantly, huge investments happening across industries. Think AI, infrastructure from the HLT Act, reshoring manufacturing.
And how does that translate into hotel stays, more business travel?
That's the connection they make. They talked about the high correlation between non-residential fixed investment and RFI, basically companies spending on buildings, equipment, and growth in hotel room nights. All that investment activity means people traveling for projects, sales, meetings.
Right. And they paired that potential demand growth with the supply side, calling it a super cycle of low new hotel supply.
Exactly. Industry supply growth is apparently at the lowest levels ever seen. So if demand picks up from all that investment, and there aren't many new hotels opening,
then existing hotels, like Hilton's, should benefit significantly. Better occupancy, better pricing power.
That's the thesis. It's the potential structural tailwind for them. And they did say they're seeing a bit of a thaw now after a slower April, June. Booking behavior is starting to recover.
Seeing some green shoots, as they say, and they expect Q4 to look more normal.
Yeah, anticipating decent leisure growth, business transient maybe comparable to last year, and group travel leading the charge. Plus, Q4 has easier comparisons to last year because of things like strikes and the election cycle.
Okay, so near-term cautious optimism for the U.S. What about China? RevPAR was down, but development is still strong. How does that work?
It's an interesting contrast. They expect RevPAR in China to stay a bit soft, maybe modest declines, partly due to what they called an austerity campaign impacting spending, but the development pipeline is booming.
Why build more hotels if demand is soft?
Because the market is fundamentally undersupplied long term. China has way fewer hotel rooms per person compared to other big economies, so there's a long runway for growth. Plus, there's opportunity to convert existing buildings into hotels, which fits their strategy.
So they're playing the long game in China, looking past the short-term bumps.
Absolutely. They're signing more deals, putting more rooms under construction there year over year because the long-term economics look good due to that undersupply.
Got it. Let's touch on luxury and lifestyle. They mentioned extraordinary expansion there, opening their 1,000th hotel in those categories, planning 3 new ones a week next year.
Yeah, the pace is incredible. But they clarified, luxury isn't the main profit driver. It's about the halo effect.
Waning.
Having those aspirational brands strengthens the whole network, makes Hilton Honors more attractive, gives customers the full range of choice. It lifts the perception of the entire portfolio.
Then lifestyle is different.
Lifestyle they see as a mega category. Thousands of potential hotels, various price points, really appeals to younger travelers, and it's very scalable. They see huge growth potential there. And while partnerships like SLH and Nomad are doing well, the focus now is more on building their own brands organically, not buying others.
And just circling back to conversions one last time, that 40% target for the year really shows they can grab market share, even if new building slows down, right?
Definitely. The market for conversions is massive independents, hotels leaving other brands. And they stress they're disciplined with key money incentives to owners, using it on only about 8% of deals. Same as always, even though it's competitive out there. Shows they're not just buying growth at any cost.
All right, we've covered a lot. Now for that part of our deep dive where we speculate a bit, remember everyone, this is absolutely not financial advice, just a thought experiment.
Purely hypothetical, do your own research. But if you were brainstorming trade ideas based on this call,
you'd look at Hilton's strengths, the pipeline, the conversion machine, the confidence in gaining share no matter what RevPAR does short term. So maybe a long position in Hilton, HLT?
That's the straightforward part. The outrageous but plausible twist would be to pair that long HLT with a short position on a different hotel company, maybe a smaller regional player, one that doesn't have Hilton's brand diversity or a strong conversion game, maybe one that's more reliant on new builds, which is tough right now.
So the idea is Hilton's model is built to win share in this environment, while less adaptable players might struggle. Betting on the strategy, not just the market.
Exactly. You're betting that Hilton's ability to convert their brand strength, like with Spark, that highest market share brand, gives them a structural edge in this low supply super cycle they talked about. The short hedges against broader market weakness while playing the specific company advantage.
Plausible because the strategy seems sound and the execution is there. Outrageous because it involves timing the market and picking specific winners and losers.
Precisely. It's a bet on execution and market share shifts.
Okay, let's wrap this up. To recap, Hilton showed real bottom line strength in Q2, even with some RevPAR softness. The story is really about growth, a huge development pipeline, fueled increasingly by conversions and new brands like Spark and LivSmart Studios.
Yep. And management's optimistic long-term, especially about the U.S., citing investment trends and low supply. China's a long-term development play despite near-term RevPAR headwinds. Luxury adds halo, lifestyle adds scale.
They seem well-positioned strategically, but again, remember, everything we've discussed today is purely for informational purposes. It is definitely not financial advice.
Our goal is just to break down the call, connect the dots for you, give you the key takeaways.
So as you think about this, consider those long-term trends, the supply constraints, the conversion strategy, the brand power. What stands out most to you? Where do you see the opportunities or risks?
Keep digging, keep thinking. We'll be back next time with another deep dive.
Thanks for joining us on The Deep Dive.